right. Good morning, everyone. I hope you can hear me. Alistair Campbell with Pacicc, and welcome to our 31st Annual General Meeting under unusual circumstances. We are still awaiting our corporate secretary, and so calling an audible, I think, is the expression here. Mr. Chair, I would suggest that perhaps we could just go straight to your remarks and my remarks, and then we could get on with the business component of the AGM once our corporate secretary has arrived. Does that make sense to you?
Yes. So you wish me to go to my remarks as the president then, or as the chairman? Sorry.
As chair, I'll do mine,
okay,
and then we'll do the business section after that. Does that make sense?
Alistair, Randy has dialed in.
Oh, fantastic. In that case, never mind my audible. Let's transfer control over to Glenn, and you're in charge, Mr. Chair.
Great. Thank you, Alistair. Certainly, this is an unusual moment in time for all of us. And first of all, I want to welcome everyone, including the designated representatives to the AGM. And I'm Glenn Gibson. I'll chair the meeting. And as we've done in the past, we've invited the regulators to participate. I'm not sure who's on the call. We were anticipating Vincent Savard from AMF, Rob O'Brien from BC FSA, and perhaps Frank Chong from British Columbia FSA. So we may get people in and out as we unfold here today, but just so you're aware, all the regulators were invited to this. So I'm going to call the meeting to order. I've asked Randy Bundis to serve as our secretary for the meeting, and I've also asked him to serve as a scrutineer. And today, during the course of this meeting, I've asked Alistair, who's our president and CEO, to assist, as well as Randy Bundy. And as you all know, we're all deeply impacted by the CV virus, and we are here today using Zoom technology, which we hope is going to work quite well. I know there's been concerns expressed about security, and they seem to be addressing that. And hopefully we're not going to have anybody Zoom us today out of the blue, so we'll cross our fingers on that one. All of our members were invited to join this meeting, and that were communicated in our notice of the meeting for our AGM. The virtual environment is a bit of a challenge, so we have done some pre-planning and to try to create an effective process, and we've prepared with motions and seconders to different things that are going to take place today. So if you are going to make a motion, please state your name fully so it can be recorded in the minutes. And when I ask for a motion, a vote on the motion, I'll ask for it to be done orally. If we do get into a situation where there's a formal vote required, I'll ask each designated representative who's on this call to state their name and the number of votes that they're authorized to cast on their behalf of their company. A notice of the meeting was mailed to all of the designated representatives on March the 18th, 2020. Our scrutineer, Mr. Bundis, advises me that he has a certificate on hand that proves its mailing. And at this point, I would request a motion to dispense with the reading of the notice and to take the same as read.
Mr. Chair, I move that the reading of the notice of meeting be dispensed with and that the same be taken as read. Sorry, that was Lynn Oldfield.
Brian, if you're on the line, I think we were counting on you there.
He may be on mute.
Perhaps if Martin is alive, maybe you could second
Yeah,
this.
this is Martin Beaulieu, and I will second this motion.
Okay, everybody, you've heard the motion. All the designated representatives in favor, please signify by saying aye. You'll have to unmute to do that.
Aye.
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 Those contrary, if any, signify by saying no. Having not heard any contrary, I declare the motion carried. I further direct that a copy of the notice and the certificate be kept with the records of this meeting. Somebody needs to unmute there. Randy Bundus is our scrutineer. I'm advised by him that at least 20% of the designated representatives are present by proxy at this meeting. So I therefore direct that a copy of the scrutineer's report showing the actual number of designated representatives we have in attendance today by proxy, and the percentage in aggregate of this number represents of the total number of designated representatives be kept in the minute book of the corporation. So regarding the quorum and constitution of our meeting, as we do have 20% of the designated representatives present representing a quorum, I now declare that the meeting is regularly called and properly constituted. So having done all of that procedurally, on all matters today, we will again take a verbal vote unless a ballot is demanded. If a ballot is demanded, then members will be entitled to cast their votes as specified in the notice sent by the corporation to each of the designated representatives. The order of events for today's meeting were set forth in the notice that we sent out for the AGM. So to begin the formal meeting today, I would ask Alistair Campbell, our president and CEO, to assist me in delivering a two-pronged approach for reporting to the activities of the board of directors. I'll focus more on our accomplishments this past year, and Alistair will focus on our priorities for the upcoming year. So, as I said earlier, certainly we meet today under very unusual circumstances, and I want to thank everyone for dialing in here and participating our first virtual AGM in our history. I'm not sure it'll be our last as we come out of this fog and we embrace some changes in the way we all do business. And I think when you look at the virus itself and its impact, I'm a very big believer when you're running a corporation and keeping your steady hand on your mission, vision, and values. And when I look at the mission of an organization, to me, it defines, what's the purpose of the organization? Why does the organization exist? When I look at this situation, we're Pacicc, and, we're there to step in and help mitigate disastrous situations when an insurance company fails. And although we haven't had that happen in a while, we certainly are being diligent about several situations, and we certainly, when we look at what can happen, and I always kind of look at, if you did get wind of the fact that your insurance company had failed and you were a policyholder and you had a claim that was in the works, how are you going to be feeling when you get that news? To be fearful, you're going to be worried about the impact. And when I look at the elements that exist today with the virus impacting us, it reflects to me on just really how important it is for us to get it right when that big moment comes. And again, it reflects on much of the journey that Alistair has led Pacicc on this past year, and also on into the near future with the priorities that we're setting as an organization. We've worked very closely with our Corporate Secretary Randy Bundis for today's meeting to make sure the legal niceties have been looked after so that this virtual session is fully legitimate. And Randy has a deep institutional memory, and I'm sure there's no precedent for what we're doing today. So it's a long way for saying, you know, we may have a few glitches today along the way, and just bear with us, and we thank you again for participating. This past year for Pacicc has been an essential component of our insurance industry infrastructure. We began this journey 15 years ago with Paul Kovacs, and also we had our chair, Laurie Savage, who stepped down last year after 14 years on the board. Both of them have provided outstanding support to both myself and to our new CEO, Alistair Campbell, this past year. From an industry perspective, many of you on the line know better than me, but 2009 was a frustrating year for the market, and you know, gross premium, high single-digit rates of growth, relative low inflation, and the industry loss ratios didn't improve at all for some, and we also saw losses across property end of things, and this has left a large number of companies that had underwriting losses. And 2019 also saw a number of carriers who were extending prior year underwriting losses into the 19 years. So we've been monitoring a lot of these activities at Pacicc, and we'll talk about the Pro Committee later today, but certainly we've been active with several situations. And working closely with the management team at Pacicc, our board has tackled a number of unusual but significant initiatives this year. The most significant was obviously the review of the coverage and benefits, which was our priority for 2019. And I think the last time this was touched or looked at was 14 years ago. Alistair is going to give you an update on the status of this situation. And I would like to say, before I turn it over to him, that myself, for sure, and the board are very pleased at how management has worked to gain perspectives from key stakeholders, including consumers, insurance regulators, and brokers. Job of engagement of the stakeholders, active listening, getting it right before we bring things to the board for a vote. And this hard work has really paid off, I think. And so when we look at going into 2020, when we looked at going in 2020, our prior issue was starting with the publication of a really important research paper, which was entitled Alternative Liquidation, Exploring Canada's Property and Casualty Resolution Toolkit. And our management teams work really hard to execute. And as we seek to ensure that Pacicc will continue to be able to honor its policyholder protection when it's needed. On the operational side of things at Pacicc, we've modernized our administrative assessment framework. That's now incorporating a risk rating, and we've ensured adequate funding for our operations in a consolidating industry. We've got lessons at play now. We've also invested resources in modernizing our contingency planning. And we reimagined stakeholder community, all know is a new social media world. The next stage of this is going to involve deeper engagement with our regulators. Our Pro Committee, which is our pre-insolvency regulator liaison committee, is comprised of our CEO and our independent directors. We've been actively liaising with key regulators, most notably OSFI and AMF in Quebec. We've been looking at scenario modeling and contingency planning, and once we'll be expanding this across other jurisdictions in Canada as we sort of gain some experience on what it's going to look like. We continue to engage the industry through a Risk Officers Forum, our emergency risks and webinars, and our quarterly newsletter, Solvency Matters. We want to explore best practices around Canada and the world, and we have particularly been interested in seeing what we've learned from the International Forum of Insurance Guarantee Schemes, and that is an organization Alistair is now going to be serving as their chair. So that's been very interesting to hear what's going on in Europe, where they have active insolvencies underway, and there's certainly things we can learn from what's emerging there, and Alistair is a great conduit for us to learn more there. Pacicc's also been working diligently on raising industry awareness for the significant risk of what happens if a large earthquake was to take out a major urban center in Canada. And we've identified options that could help mitigate the material tail risk for our industry and our country. Canada is the only significant developed nation in the world with a material quake exposure that does not have some form of industry backstop mechanism. That is a very significant statement. Our board has designed mitigating systemic risk as a permanent priority issue for Pacicc management until such time as we can get a satisfactory resolution. I want to thank the small management team for the large volume of quality work we received over the last year. I'm amazed at just what's coming out of this small working group, and I'm amazed at the energy of Alistair and his team, and how they have pushed me down the road and engaged me on just so many different things. It's been a real experience and a real learning experience for me as well. And I think that the team has really bonded around Alistair's style and his aggressive to do, get things done attitude, and I think we all benefit from that. I also want to thank the members of the board for their professionalism, and they're dedicated to our mission this past year. They've made my year, as I say, very rewarding, and I have every confidence that we are in very good hands with our management team, and that we will continue to strengthen our ability to protect consumers in the days ahead. You know, there's an old saying that I use, and I didn't invent it, but it's proper planning prevents poor performance. And I think that Alistair certainly has helped us move in that direction. And I think we're very much further down the road than we were 12 months ago on what we need to do as an organization to be ready for that chance to dance if something goes bad in our country. So having said that, Alistair, I will turn that over to you.
Thank you, Glenn, and thank you for those kind words. Let me start by thanking all of those who have joined us in person or remotely for today's meeting. These are challenging times for Canada and the world, and we've done our very best to ensure we can perform our corporate legal obligations today in a way that best ensures the health and safety of all involved. I'd like to say a few things about Pacicc and our work over the past year, and I thank you for your patience and your interest. First of all, it's safe to say that the three-part mission of Pacicc was successfully achieved in 2019. We can confidently claim that no consumer suffered undue hardship as the result of an insurer insolvency. Second, the absence of any new insolvencies meant that the cost to insurers were certainly minimized. In fact, we began 2019 by successfully completing the process of returning $21 million to our insurer members. This sum representing the final amounts recovered from the active estates of all previously failed insurers in Canada. Finally, confidence in the P&C industry among consumers remains high. A recent survey indicates they have no concern about the solvency of their own insurer, that of the industry in general. As we've just seen from recent events in the world, consumer views can change rapidly. So we have to keep that very much in mind. The work of Pacicc intensified this year on a number of fronts. Our priority issue for 2019 was the formal review of our coverage and benefits, which Glenn just referenced. We engaged our members via a working group and broadened that industry engagement to include a formal process, both with IBC and with IBAC. We completed this portion of the work by issuing an industry consultation paper with 10 preliminary recommendations based on 3 guiding principles: fairness, transparency, clarity, and modernization. And then we went on to survey our entire membership on their views. We were very pleased that more than 83% of the Canadian market responded to that survey. Member input, combined with industry feedback and the results of qualitative and quantitative consumer market research, propelled us well for the dialogue we then initiated with the Canadian Council of Insurance Regulators. Their response enabled us to complete a comprehensive stakeholder map and enabled Pacicc management to table final recommendations at our November 2019 board meeting. After exhaustive discussion and debate, our board approved the most significant changes to coverage and benefits since 2006. These changes include an increase in the personal property limit to $500,000 and an increase in automobile and commercial limits to $400,000. The board also decided to increase the unearned premium amount to $2,500 while retaining the 70% copay obligation, meaning a maximum individual payout on unearned premium of $1,750. The Pacicc board also approved a fixed review date in future, requiring a review of coverage and benefits every 5 years, and committing that the next review, conducted in close collaboration with CCIR, would take place within 36 months. Amongst other approved changes was some broadening of coverage in line with proposals made by our colleagues at IBC, as well as some other technical adjustments to our model, including plain language definitions for covered lines, intended to improve the clarity and transparency of communication with the consumer. Finally, our board formally asked CCIR to publicly join IBC and Pacicc in calling upon the Government of Canada to create some form of backstop mechanism to address the systemic risk associated with a megaquake in BC or the Montreal-Ottawa corridor. Our 2020 priority issue is expanding Pacicc's resolution toolkit. Key to this work, we'll be moving to institutionalize our working relationships with AMF and OSFI, as well as BCFSA, where we have now signed intervention protocols, and moving to establish such intervention protocols with the other provinces. Also important is continuing to flesh out the mandate and working practices of our new Pre-Insolvency Regulatory Liaison Committee, the PEARL Committee, made up entirely of our independent directors. We began to socialize this important work around a resolution through a meeting with the IBC Board of Directors and via a series of workshops at the National Insurance Conference of Canada. And in 2020, we have now begun executing on our comprehensive 4-part action plan for this priority issue. Now, Pacicc remains seized by the critical importance of addressing the risk of systemic contagion potentially caused by a major earthquake. We engaged with IBC and Finance Canada constantly on this topic throughout the year and remain disappointed that we have not been able to make greater progress. We have made strides to align with CCIR and IBAC in this important cause, and we intend to renew our efforts on this issue in 2020 now that the federal election is over. Historically, Pacicc's board has limited management's mandate to a single priority issue each year, given the limited resources at our disposal. However, recognizing the urgent priority to address this systemic risk topic, our board has designated mitigating systemic risk as a permanent priority issue until such time as we secure the required resolution. Accordingly, we will be redoubling our efforts to address this issue and will not rest until we have achieved success. I might add that the experience that Canada is undergoing around pandemic amplifies the compelling case to have an in case of emergency break glass, fully prepared action plan to deal with tail risk events. The pandemic is one, quake is another. And we have a compelling argument to make now that it is time to address this systemic exposure. Looking out beyond 2020, We've already begun work on our board designated priority issue for 2021, contingency planning and desktop simulations. We're working much more closely with key regulators than ever before and now have early warning regarding potentially distressed insurers. This means we now have the opportunity to engage more proactively in crisis management simulations, where pre-planning might assist in ensuring more effective response to worst case scenarios when they actually happen. Finally, we've been asked by our board to start thinking strategically about Pacicc brand awareness. We have begun by seeking to engage with IBC and IBAC in a more structured and sustained way, and we've expanded our industry awareness through the publication of our Solvency Matters newsletter, through our highly successful Risk Officers Fora, and through an increased number of public speaking engagements. But over the course of the coming year, we will be giving more thought to ways that we can ensure all market-facing players in our industry have a better awareness of the Pacicc value proposition and can make that value more visible to Canadian consumers. I'd just like to conclude by saying I have found the first year in this role both challenging and deeply rewarding. I sincerely appreciate the engagement from our board, and I'm particularly grateful for the coaching and guidance I have received from our new board chair, Glenn Gibson. I've also benefited immensely from the highly engaged and deeply professional team I have inherited here at Pacicc. We've accomplished a lot in this year and look forward to achieving even more in the pursuit of our mission in 2020 and beyond. Thank you for your patience with all of that. Happy to turn the con back to our chair, Glenn Gibson.
Thank you. I will pause for a moment to see if there's any questions coming out of that. Questions, anyone? Nothing heard. I'll carry on. I wish to point out that the report of the board includes the audited statements of the corporation for the year end December 31st, 2019. These statements were sent to all members, member companies as part of our annual report, and it was sent along with our notice regarding this meeting. These statements don't require a resolution by members. They are there for your information only. I'm going to ask Samir Chowdhury from KPMG today to read the certificate as to the audited financial statements.
Thank you. I'm just checking whether people can hear me.
We can.
Okay, fantastic. So this is the report that accompanies the audited financial statements of Pacicc. We have audited the financial statements of the Property and Casualty Insurance Compensation Corporation, which comprise the Statement of Financial Position as at December 31st, 2019, the Statement of Comprehensive Income for the year then ended, the Statement of Changes in Equity for the year then ended, the Statement of Cash Flows for the year then ended, and notes to the financial statements, including a summary of significant accounting policies, hereinafter referred to as the financial statements. In our opinion, the accompanying financial statements present fairly in all material respects the financial position of the entity as at December 31st, 2019, and its financial performance and its cash flows for the year then ended in accordance with international financial reporting standards. We conducted our audit in accordance with Canadian Generally Accepted Auditing Standards. Our responsibilities under those standards are further described in the auditor's responsibilities for the audit of the financial statements section of our auditor's report. We are independent of the entity in accordance with the ethical requirements that are relevant to our audit of the financial statements in Canada, and we have fulfilled our other ethical responsibilities in accordance with these requirements. We believe that the audit evidence we have obtained is sufficient and appropriate to provide a basis for our opinion. Management is responsible for the preparation and fair presentation of the financial statements in accordance with international financial reporting standards, and for such internal control as management determines is necessary to enable the preparation of the financial statements that are free from material misstatement, whether due to fraud or error. In preparing the financial statements, management is responsible for assessing the entity's ability to continue as a going concern, disclosing as applicable matters related to going concern, and using the going concern basis of accounting unless management either intends to liquidate the entity or to cease operations or has no realistic alternative but to do so. Those charged with governance are responsible for overseeing the entity's financial reporting process. Our objectives are to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error, and to issue an auditor's report that includes our opinion. Reasonable assurance is a high level of assurance, but is not a guarantee that an audit conducted in accordance with Canadian generally accepted auditing standards will always detect a material misstatement when it exists. Misstatements can arise from fraud or error and are considered material if individually or in aggregate they could reasonably be expected to influence the economic decisions of users taken on the basis of the financial statements. As part of an audit in accordance with Canadian generally accepted auditing standards, we exercise professional judgment and maintain professional skepticism throughout the audit. We also identify and assess the risks of material misstatement of the financial statements, whether due to fraud or error, design and perform an audit procedure responsive to those risks, and obtain audit evidence that is sufficient and appropriate to provide a basis for our opinion. The risk of not detecting a material misstatement resulting from fraud is higher than for one resulting from error, as fraud may involve collusion, forgery, intentional omissions, misrepresentations, or the override of internal control. We obtain an understanding of internal control relevant to the audit in order to design audit procedures that are appropriate in the circumstances, but not for the purpose of expressing an opinion on the effectiveness of the entity's internal control. We evaluate the appropriateness of accounting policies used and the reasonableness of accounting estimates and the related disclosures made by management. We conclude on the appropriateness of management's use of the going concern basis of accounting, and based on the audit evidence obtained, whether a material uncertainty exists related to events or conditions that may cast significant doubt on the entity's ability to continue as a going concern. If we conclude that a material uncertainty exists, we are required to draw attention in our auditor's report to the related disclosures in the financial statements, or if such disclosures are inadequate, to modify our opinion. Our conclusions are based on the audit evidence obtained up to the date of our auditor's report. However, future events or conditions may cause the entity to cease to continue as a going concern. We evaluate the overall presentation, structure, and content of the financial statements, including the disclosures, and whether the financial statements represent the underlying transactions and events in a manner that achieves fair presentation. We communicate with those charged with governance regarding, among other matters, the planned scope and timing of the audit and significant audit findings, including any significant deficiencies in internal control that we identify during our audit. That brings me to conclusion of the audit report.
Thank you very much. We are now going to move on to the election of directors pursuant to bylaw number 1. The directors are to be elected from individuals nominated by the board of directors and by any designated representative who files a written nomination with the secretary not less than 5 days prior to this meeting. The secretary has informed me that there were no written nominations filed for the election to the board. So the following 12 directors were nominated by the board for election as directors pursuant to paragraph 29 of bylaw number 1. Martin Beaulieu of Intact Financial Corporation, Alistair Campbell of Pacicc, Andrew Cartmel of Saskatchewan Government Insurance, Brian Issa of Red River Valley Mutual Insurance Company, Christian Fournier of La Capitale General Insurance Company, Glenn Gibson of the GTG Group, David McNaughton, who is a consultant, Heather Masterson of Travelers Canada, David Oakton, who's a consultant, Lynn Oldfield, who is with AIG Insurance Company of Canada, Bruce Thompson, who is a consultant, and finally, Peter Walker, who is with Aviva Canada. Anyone we elect as a director at this meeting will hold office until our next AGM, which will be in 2021. Particulars of those who are nominated were included with the information letter which accompanied our notice of the AGM. The individuals we nominated constitutes a complete slate of directors. I would ask for a motion for the nominations to be closed. We're looking for Heather, I think.
So my apologies. I motion for us to approve.
It's Andrew Cartmel. I second that motion.
You have heard the motion. All designated representatives in favor, please signify by saying aye.
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 Those contrary, if any, signify by saying no. Not hearing any no's, I declare the motion carried. As the motion has passed, there are a number of nominees for position to be filled. I declare the nominees to be duly elected directors of the corporation to hold office in accordance with the bylaws until our next AGM or until their successors are elected or appointed. Our next order of business is the appointment of the auditors. I would ask for a motion by a designated.
This is Martin Beaulieu. I move that KPMG Chartered Accountants Toronto, Ontario be appointed auditors of the corporation to hold office until the next annual meeting of members or until their successors are appointed, and that their remuneration be fixed by the board of directors.
Peter Walker, I second that motion.
You've heard the motion. All designated representatives in favor, please signify by saying aye.
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 Those contrary, if any, signify by saying no. I declare this motion carried. We now move to approving the actions of the board of directors and officers of Pacicc. I would ask someone to move that all acts, contracts, proceedings, appointments, elections, and payments enacted, made and taken by the directors and officers of the corporation since our last AGM of members, as the same are set out or referred to in the minutes of the meetings of the board of directors of the corporation, be approved and confirmed.
This is Lynn Oldfield, Mr. Chair. I'm pleased to make such a motion.
Brian seems to have a problem. Martin, are you our backup guy here?
Yes, I will second that motion.
Thank you. You've heard the motion. All designated representatives in favor, please signify by saying aye. Those contrary, if any, signify by saying no.
Aye.
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 Sorry, those contrary, any no's? Not hearing any, I declare this motion carried. I would ask if there's any new business to be brought forward to today's meeting. Not hearing any, I would ask for a motion to terminate the meeting.
This is Martin Beaulieu. Mr. Chair, I move that the meeting be terminated.
Peter Walker, I second that motion.
Peter Walker.
Yep. Can you hear me, Glenn?
Yes, got it.
Sorry. Yeah, Peter Walker,
heard-
I second that motion.
Thank you. You've heard the motion. All designated representatives in favor, please signify by saying aye.
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 Those contrary, if any, signify by saying no. Having heard none, I declare the motion carried and the AGM is now terminated. I'm now going to invite Ian Campbell, who is our Vice President of Operations with Pacicc, to provide an overview of the paper, Why Insurers Fail, and and lessons learned from the failure of the Reliance Insurance Company.
Thanks very much, Mr. Chair. This is our 14th publication of Why Insurers Fail. It's a series, a research series we started in 2007, an original research series for Pacicc, and we're very proud of this. And we use our annual general meeting as an opportunity to launch the report to the industry. And with this report, we always seek to tell a very interesting story. And I think we've got a good one this year. I look at ourselves as cold case detectives for the P&C insurance industry. So this happened back in 2001, and events decades prior to that are raised in the report. So I think you'll find it a very good read. It's a presentation of the facts about a very significant insolvency. And the value add that we bring here is we talk about the causes of the insolvency and the lessons learned for both insurers and for regulators. And I want to, there's pressure on my colleague, Grant Kelly. I know he's out there and he's watching this presentation now. He and I alternate each year to write the Why Insurers Fail report. So the moment that I finish going through this report, the countdown clock starts on Grant's report for next year. So 365 days start my very last word this morning. So pressure's on you. Okay, the first slide. So why of all insurers this insurer? This was the largest US insurer insolvency ever. It had a negative surplus of $1.1 billion when the company went bust in 2001. And we heard from guarantee funds in the States in June 2019, payouts now total well over $4 billion. And this includes claims payments and administrative expenses. The next largest failure, to put things in perspective, was Legion Insurance Company in 2002. And the extent of damage there was $1.2 billion. The impact of changes in a company's risk appetite is striking in this report. You had a company here that had a very solid history, careful acquisitions. They built the business 184 years, very steady growth, attentive underwriting, and all of a sudden under new management, there was a marked change in the risk appetite of the organization. We're going to talk, you'll see later on, about flaws in the corporate structure and the governance of this insurance company. Essentially, the board of directors was a club, heavily conflicted, very self-serving, and unchanged for years and years. There was a lack of independence to challenge management decisions on any front. And there was a very dramatic change in the capital base in the short space of 3 years. In mid-1998, the company had a record net worth of $2.3 billion. And in October 2001, when it became insolvent, it was posting a negative surplus of $1.1 billion. There is a similarity with this report to two other insolvencies that took place that same year. One of them I wrote up back in 2018, that is lessons learned from the failure of HIH Insurance Limited in Australia. That firm had an asset deficiency of between $3.6 billion and $5.3 billion. And there was also independent insurance in the UK where there were irregularities in claims accounts that caused that insurance company to go bankrupt. Interesting thing about this report and these three companies, each of them was led by an industry maverick, a person that as CEO was exerting undue influence over the organization. The companies were operating with flawed business strategies, and they were very intent on gaining market share from larger competitors in the industry. Also unique about this case is this was a liquidation of a solvent Canadian branch, Reliance Canada. A very unique situation. To think about it, it's a forced closure of a profitable firm. The parent company went bankrupt, the operation in Canada fully profitable, but forced to close. And finally, the novel approach that we as an organization took to resolve this situation, Pacicc pledged its assessment power, and this gave comfort to the liquidator to quickly process claims and thereby avoid the time and expense of a traditional assessment to the industry. I could ask you, Alistair, to go to the next slide. And that's a background on, or the next slide is a background on Reliance Insurance Company. So the story begins in Philadelphia back in 1817, a 184-year history with this organization. It had originally started as the Volunteer Fire Association of Philadelphia, grew to the 27th largest insurer in the US, a very sizable firm, 8,000 employees, 13,000 shareholders, $350 million in revenue, and $100 million in capital reserve. It was a national insurer with a full range of product lines from basic property and auto to specialty lines, including workers' comp, non-standard auto, and professional liability. It grew steadily over the years through acquisitions, careful acquisitions, and those were put on hold in the late 1960s when the firm endured quite a number of property losses, uncontrollable events, hurricanes, and also it was dealing with property losses from the race riots in 1967. Things changed in our next slide, slide 3, is with Saul Steinberg and Leasco. He's a protagonist in our story, a young and highly ambitious individual, and would play a key role in the future of Reliance Insurance Company. He was born in Brooklyn, New York in 1939, attended the Wharton School of Finance. He was a graduate with a background in economics. And during his time there, he was really obsessed with the IBM business model of leasing. He did a paper entitled The Decline and Fall of IBM, which is highly misleading because he was quite enamored with the success of IBM and their leasing of large mainframe computers. It was always on his mind. When he graduated, he established the Ideal Leasing Company. He was just 22 years old. He had $25,000 of seed money from his father and established that firm. And it was intent on leasing computer hardware, essentially taking products, taking IBM computers that were coming offline and leasing them back into the industry and taking advantage of some of the tax write-offs. In 1963, the firm Ideal Leasing reported $1.8 million in revenues, and this grew to $74 million in assets and 800 employees by 1967. Very, very sizable growth. That led to a number of acquisitions. He was really intent on acquisitions. He bought up CTI, Container Transport International, and grew this jointly with his computer leasing and the world's largest cargo container transportation company jointly. So it was a mixed bag. He really didn't care as long as the firms were profitable. It was kind of a dog's breakfast of what he put together, computer leasing and cargo containers, but it was working for him. And he was always on the in search of new acquisitions. Disney and Chemical Bank caught his interest. He was very shrewd and ambitious. No company was too large to interest him, and he had a number of failed bids along the way. Those are two of the companies that he pursued, but to no end. If you Google Saul Steinberg, one of the things that comes up is Greenmail as a source of profits. He was big on this. He was one of the proponents of this. He had a reputation for hostile takeover bids, but never actually completed one. He had a very simple formula for success, and that's to attract investors to take over a company, pressure the company to cut costs, and almost appear reckless. And when the board, essentially management, fights back, he would sell off the accumulated stock at a profit. He did exactly this with Disney and made himself $58 million. He threatened to fire the board of Disney and sell off all the cartoon characters to the highest bidder. So it was ruthless, sinister, but also very, very profitable. It's kind of an evil genius outlook he had on life. Slide number 4, Edward Netter is another person that figures prominently in our story. He was a Wall Street financial analyst with Carter, Burland, and Wheel. And he had this visionary concept of creating a large financial services firm. He penned a very obscure client report entitled The Financial Services Holding Company. And essentially this challenged the central tenet of the Glass-Steagall Act of 1933, that it was possible for non-financial holding companies to take over a financial firm and transfer an insurance company's unallocated surplus to the unregulated holding company. They were then free to invest the assets back in the organization or maybe in other enterprises not necessarily related to the insurer. He predicted back then, at a very early stage, the emergence of large all-encompassing financial services firms. And this non-financial holding company model could overcome investment hurdles such as the Glass-Steagall Act, which required the separation of US banking, insurance, investment, and industrial company operations. So Edward Netter, in his report, came up with the terms redundant capital and surplus. Essentially, he looked at P&C insurance practices, found they were highly conservative, and they produced reserves exceeding regulatory requirements. So it was very, very attractive for takeover bids. Unlocking value for investors, he saw great potential here. Ambitious, diversified companies, essentially, they could marry with fire and casualty insurance companies and seize their redundant capital. It's almost like a dowry. They looked at it like. So Steinberg brought Netter in as an advisor to help look for insurers that could produce strong balance sheets and surplus capital. He looked to him for identification of suitable candidates. And they were always very careful not to name the companies that they were looking to take over, because this could lead to stock price stimulation and management opposition. So what they did, they actually were using actresses' names to name the companies, such as Marilyn Monroe and Greta Garbo. They had code words to Marilyn and Greta in going through and talking about the target firms that they were after. So Reliance, Edward Netter earned a finder's fee of $750,000 for recommending Reliance finally to Saul Steinberg as a takeover target. Slide number 5. And now we just look at the development under Steinberg's guidance, how the organization evolved over the coming decades. I took a decade at a time and looked for major events happening during that decade. In the 1970s, he was carrying a very huge debt load. There was a 1968 takeover of Reliance Insurance Company. It was very successful. It was debt financed, an unsolicited takeover bid. $400 million in stock was issued to fund the deal. And essentially, this is really remarkable because Leasco took over a company 10 times its size, and that gave it access to $125 million of capital. And the key focus here for Steinberg in the 1970s was structural and operational change. It was a challenging decade for him, managing this company's huge debt. All of a sudden, he's strapped with. And so he changed the name from Leasco to Reliance Group. He wanted to be known as a financial services firm and get away from the leasing handle. And he established, you'll see it on the next slide, we'll come to that in a second, but he established a holding company arrangement. Reliance Financial was established as an intermediate holding company, and he also established sister organizations, Reliance Consulting and Reliance Development, which looked after real estate. And this would be the organizational framework that would guide them forward for years. An issue came up in the 1970s for Steinberg, and that is Moore's Law. Gordon Moore, the Intel Corporation co-founder, had a theory that computer power doubles every 2 years due to advances in hardware technology. And Steinberg was late to learn this. He was heavily invested in aged computers and found that with the rapid advances and IBM going to market with later and more powerful products, he was now sitting on millions and millions of dollars of computers that nobody wanted to rent. The stock price subsequently plunged, a very dramatic plunge in 1975, and it was a very terrible time for the company. But he also saw opportunity in this. There was an opportunity to buy back shares. So he used company funds to buy back shares from angry investors, and that helped him to increase the total shares that he controlled in the organization. And slide number 6 will show us the corporate structure for his holding company arrangement. Alistair, if you could just advance one. There we go. Good. So this, you're not seeing there, you will see it in the printed report or the report that we're going to post on the Pacicc website, but there are 22 organizations underneath Reliance Insurance Company where I've just kind of done a cutaway. So I've kind of lopped off the head of the beast here. And this is the arrangement that very, very solid, nothing changed here over the years. He had a holding company up top called RGH, Reliance Group Holdings. And then he had 3 sister organizations, and really Reliance Financial did all the heavy lifting here. So there was Reliance Development and Reliance Consulting at the same level, but it was Reliance Financial that was the intermediate holding company and the conduit for profits from Reliance transferred up in form of dividends to Reliance Financial and then up to the RGH. And that was controlled, the RGH was controlled by the Steinberg family, 47%. So when there were dividends going forward, they were going right into his pocket. He was paying himself first. The 1980s represented a refocus in business strategy, a change in strategy. The organization became very active worldwide. They were active in every state, 50 states and 50 countries. They're both near and far. They were in Puerto Rico, Guam, Virgin Islands, Mexico, Asia, Europe, Brazil, and Canada. Reliance Group Holdings, there were changes there to lock down control. So there was a reorganization of the board. Steinberg inserted his father, his brother, and several close friends on the board of directors. A very dysfunctional board. 3 of the directors served on the board for 16 years. Many of the directors were officers, and always internal directors outnumbered external directors. So he was very insulated in terms of protection from management and any negative feedback he might get in terms of direction over the organization. He was using junk bonds to fund all the acquisitions, and that was just leading to huge debt. Leveraged acquisitions, millions and millions of dollars in debt. He hired the nation's leading financiers, Michael Milken from Drexel Burnham Lambert and Company, the junk bond king, was brought into the fold. And it always put pressure on Reliance Insurance Company down at the bottom to be profitable and to transfer the dividends upward. This was very critical to the success of the house of cards that he had built. Saul lived a very lavish lifestyle, and he was a real playboy, one of the best paid executives in the US. He had a 29-room mansion on Long Island. He had a sprawling 80-room Park Avenue apartment built by the Rockefellers in the 1930s. He was a big fan of old masters paintings and flew around in a private jet with bedrooms in the jet. And he threw parties for himself where he had gorgeous women dress up to model some of the old masters paintings, to recreate the paintings in real life at some of his parties. So he's really living to excess with other people's money. And the decade closed with a crisis close to the end of the decade. There was pressure on Reliance, the large volume of dividends flowing to RGH to service the massive debt, that had to keep coming. Reliance, the stock value plummeted due to the stock market crash in 1987. There were property losses from natural disasters that decade, the 1989 San Fran earthquake, and fierce price competition in the marketplace. So he closed the decade with the establishment of Reliance National. And this would be a firm that would focus on non-traditional risks, and that becomes very, very important in the 1990s. The problem with very ambitious growth started out in the 1990s. There was a hiccup to start the decade, the collapse of Drexel Burnham Lambert, Michael Milken going to jail, convicted for securities law violations, and the disappearance of the junk bond market. The organization made very significant investments abroad in Europe, Asia, Africa, and Latin America. And there were 21 companies you didn't see in that corporate framework I just showed previously, but 21 organizations shows you the depth of expansion of the organization. And RGH, at this point, the parent company was $900 million in debt by the end of 1994. And he found himself in the 1990s unable to pursue the investments he wanted. Pennsylvania adopted the Model Holding Company Act, governing the operations of holding companies and the acquisitions of insurers by non-insurers. And also the Department of Justice was looking into acquisitions that lessened competition in the marketplace. So this really constrained his ability to flex his muscles with acquisitions. Reliance was under pressure in this marketplace for higher profitability. And a decision was made in 1991 to exit personal lines in favor of specialty lines of coverage. And they were now focusing on unique exposures. 2/3 of the business was coming from this: nuclear power plant coverage, environmental disasters, earthquake exposed construction, chemical manufacturers, professional liability, workers' comp, high-risk drivers, health and transit. The years 1995 to 2000 were the final years for the organization. He was riding high in the middle of the decade. The value of the organization, $2.3 billion, was a high point. 3.4 billion in revenue, 12.8 billion in assets, 1.7 billion in statutory surplus, 585 million in profits, but there were problems brewing on several fronts. During that decade, I talked about the dividend transfer. In those space of 5 years, 1995 to 1999, $166 million was transferred from Reliance insurance companies up to the Steinberg family at the top. But there's a whole confluence of negative developments in the 1990s, especially 1995 to 2000, that essentially killed the company. Those were negative underwriting results in the high risk and specialty lines. There was a soft market, price competition, very aggressive marketing by competitors, and heavy losses on the non-standard auto product. Reliance was involved with a unicover scheme. This was a reinsurance fronting scheme, and essentially it was used to pool shares of workers' compensation risk, and Reliance had very significant exposure here. They were heavily invested in workers' comp. In 1997, there was a California decision that also factored in with HIH Insurance Limited to cause them to be quite unprofitable, and it affected Steinberg here as well. It allowed for more claims and allowed the claims to be retroactive. So essentially 50% of the Reliance premiums were coming from workers' comp and general liability, and they were not pricing those products properly because this was made retroactive. So they were kind of caught in the lurch. They got involved with very and extremely risky investments, very poor investment results. 92% of their portfolio invested in junk bonds and one technology stock in 1999, which gives people pause for thought there. And also a shift to short-term debt financing, which at the end of 2000 really caused a cash crunch for the organization. Essentially, short-term debt was increasing by 50%, and the senior notes and debentures were down by 34%. I think that is shown on slide 10. Okay, that's dividend transfer, that's fine. The dividend transfers, this shows essentially, if you look at the bars in blue were the dividends flowing up to Reliance insurance companies from all its subsidiaries, and the red was the transfer from Reliance to the RGH on the top. So you see that RGH essentially could not be profitable unless or without Reliance being involved here. So quite a huge transfer and very reliant in 1988, 99, and 2000. And now the next slide, I think, shows the, there we are, outstanding debt. You see how the long-term debt is decreasing and the short-term debt is increasing, and it's all coming to a head in the year 2000 when there was a really big cash crunch. In slide 12, we talk about regulatory intervention. This paper looks at several early warning signs that were perhaps missed by regulators. I'm going back in time. I'm relying on public information available at the time. It's really hard to pinpoint and say definitively that the Pennsylvania Insurance Department dropped the ball on this, but certainly there were signs that there was trouble for the organization. The Insurance Regulatory Information System test ratios for 1995 to 1999, test number 3 for Reliance showed sudden and sustained double-digit increases in the policies written. They were gaining market share in a soft market, and likely this was coming from inadequate pricing rather than pricing up the products that they already had, customers they already had. They were trying to attract new customers with lower prices. Test number 8, the liabilities to liquid assets test, is an early indicator of financial trouble. They were failing that test. And also test number 12, the estimated current reserve deficiency, they failed from 1997 onward. And finally, shareholder dividends requiring regulatory approval. People were questioning that aloud in the trade presses. How was Reliance getting away with this, especially when you add it all up, $166 million in the space of 5 years to the family, and some of that had to be approved by the regulator. So how was that done? How could that be approved? Cash flow became an issue in August of 2000. The Pennsylvania Insurance Pennsylvania Insurance Department stepped in to oversee the dividends and disbursements for Reliance. They required detailed financial information and business plans and proposed material transactions. than proposed material transactions. November 2000, Reliance defaulted on $538 million of loans, and their surplus was sharply decreasing. And also, policyholders were coming forward with new claims, which further drew that down because they were worried about the future of Reliance and they thought we better get our claims in now. There was a downward spiral in the stock price beginning in June 1998, and it was fed by bad credit ratings and negative press, and it was just a slide right down to zero until the firm was delisted on the New York Stock Exchange in December of 2000. In January of 2001, January 29th, a formal supervision was ordered. The Pennsylvania Insurance Department installed permanent overseers to manage Reliance operations. In April 1 of 2001, Reliance said their 2000 financial statements were not complete, and they reported a surplus of $624 million, and it's now to a negative 220, now it's negative 220 million. In May of 2021, there was a rehabilitation order executed. Reliance was ordered to produce the financial statements for 2000, and they found that they came forward with unaudited financial statements, and it showed a surplus now of negative $730 million. So they lost $510 million in 11 months, and things were just getting worse. On September 1st, the Q1 for 2001, the financial statements showed a surplus now of over $1 billion in the red. A very bad situation and getting worse. They were hemorrhaging cash. Reinsurance recoverables were 60% of Reliance's cash flow, and this was slowed down obviously because of at the time the 9/11, the World Trade Center attacks, which caused serious cash flow problems with lots and lots of reinsurers. And finally, October 3rd, 2001, a liquidation order came through, killing the company. The aftermath of this is on slide 13, thank you. Mid-1998, we saw they were on a high of $2.3 billion and a stunning reversal of fortunes, a net worth of $1.1 billion negative just 3 short years later. Very significant job losses, massive investment losses, and big costs to the industry. This is felt both at the personal level with workers losing jobs and severance pay, and also at the corporate level with banks and bondholders losing very significant investments, up to $700 million. There were 187,000 outstanding claims at the time of the insolvency. When it was declared insolvent, there were 7,000 pensioners left with pensions underfunded to the tune of $100 million. And our colleagues at the National Conference of Insurance Guarantee Funds confirmed that 80,000 claims made their way through to US P&C guarantee funds. And as of, I mentioned earlier, as of June 2019, those claims, those payouts, guarantee fund payouts, exceeded $4.4 billion. This is a bad soap opera, and it's a 2-part story. If this is a drama, we looked at this as Act 2 with Reliance Canada. It was active in the Canadian marketplace since 1918. In all lines, property, accident and sickness, auto, boiler and machinery, fidelity, liability, and surety. They specialized in professional liability for lawyers, engineers, architects, dentists and hospital programs, directors and officers liability, pollution and environmental liability, and product liability. Very established in the marketplace. In August of 2000, OSFI recognized what was going on in the US and froze the assets of Reliance Canada and directed it to stop writing new business in early 2001. When the Pennsylvania Insurance Department stepped in with the liquidation order on the 3rd of October, OSFI responded just 2 days later on October 5th, seized control of the assets, and this is due to financial difficulties with the parent company. They set up an immediate ring fence to keep the assets in Canada. They cited a need for immediate action here, that the US court was likely to force the transfer of the surplus, any surplus funds in Canada to the US. The company lacked funds to cover any material increases in gross liability in Canada. There was concern about current liabilities being perhaps underestimated here, and also uncertainty about the collection of reinsurance with what was going on in the States with the 9/11 travesty. We looked, Pacicc signed a loan and services agreement with the liquidator. We borrowed from the Canadian estate of Reliance Canada with funds repayable only if dividends from the estate were less than 100%. Pacicc was required to provide a $50 million covenant from the compensation fund or assessment capacity to secure the agreement with the liquidator, and the recovery on claims was 100%, so we weren't required to advance funds. This was a very unique approach. We pledged our assessment power, and that enabled the liquidator to provide adequate comfort to pay stakeholder claims immediately. They'd otherwise be personally liable for any preferential payments if the estate was unable to pay claims fully. This took pressure off the assignment of claims and facilitated faster payment of policyholder claims. And it also spared people, other insurance companies here in the marketplace in Canada like this. It spared members the time and expense of a traditional assessment to deal with this insolvency. The liquidator here had trouble closing the file, encountered complexities with both the reinsurance and the valuation of liabilities. It took 17 years to close the file. Reinsurers demonstrated a reluctance to accept the assignment of reinsurance. There were delays in the collection of reinsurance proceeds, and there were class and crown actions against Rothman Benson and Hedges Inc. and Imperial Tobacco Company Limited. The liquidator had struck tentative agreements subject to court approval with those organizations, and attempts to settle were not approved by the court due to the intervention of Quebec class action reps and also 8 crowns that were suing the tobacco companies directly that didn't want to be bound by broad language wording in any WURA rulings. The court found here that crowns are not bound by the WURA, the Winding Up and Restructuring Act. They can pursue separate and direct action against the tobacco companies under separate legislation. This kind of set up a dilemma for the liquidator here in Canada, a catch-22 situation, and that's why it went on so long. The file remained open indefinitely while they tried to bring this to a close. Eventually, the claims were transferred to Westport, and $104.7 million of surplus was transferred to the US liquidator. The paper also looks at a case study of the home insurance company. I want to thank my colleague Jim Harries, who penned this case study, which has been inserted in this case study because it is very relevant and it's a parallel situation. There's a US parent that became insolvent in June 2013. A winding up order was issued for Home Insurance Canada 2 weeks later, and this organization was already in the process of winding down operations since the mid-1990s. They were writing only commercial insurance at the time and sold professional lines 14 years earlier. They sold them off. So this was a very solvent insurer. It had net assets of $39 million, no questions about this. And there was a short-term loan and services agreement signed with the liquidator. We had to pledge $10 million of general assessment capacity. And finally, that was resolved in 4 months. Long-term, the business was transferred to Lombard. It was a good commercial result for stakeholders, the prompt sale and transfer of business, and no need to assess Pacicc members. And just a couple more slides. The causes of the reinsurance insolvency in our situation, the insurer here was very focused on growth at all costs. Net premiums written grew by 16% on average between 1996 and 1999. It was in very risky lines of business, and this was a very big gamble for Reliance. Its pricing was very, very aggressive. It was done so to support a very ambitious growth strategy. Rapid growth in a soft market is a sign of underpriced products. There was a faulty and dysfunctional governance structure. Decisions were often made to benefit the Steinberg family. It had exerted 47% control over the organization. The board was static, it was conflicted, it was passive, and lacking independence. Reserving was inadequate. Reliance significantly underestimated future claims costs. Some of it wasn't their fault necessarily with the workers' comp, but still, that was a situation they had to deal with. And they were overly optimistic, perhaps, with some of their pricing and reserving. The investments, very, very risky. They were focused in below investment grade bonds and stocks, and the worsening credit and a deteriorating market for lower grade debt made it very difficult to refinance the debt, and all that came to a head in the year 2000. And finally, capital management. Reliance found itself unable to refinance its debt. It had difficulty managing its capital. Surpluses were continually depleted by shareholder dividends and passed forward to RGH. A possible contributing factor is regulatory supervision. That yes, the Pennsylvania Insurance Department acted decisively when it was very clear that Reliance was in deep trouble, but I did mention some early warning signs and perhaps those were overlooked. The lessons learned we draw from this, this is almost like a don't run with scissors type situation. Reserving adequate provisions for outstanding exposure are critical to the financial health of any insurer. With underwriting, it's important assessing and properly pricing risks is vital to an insurance company's long-term success. If you're entering new markets, companies should exercise caution when doing so and entering new lines of business. With acquisitions and joint ventures, they should support the strategic objectives of the organization and not necessarily be drawn in just because they're profitable, but not a good fit with the family of companies. Financial statements we saw here was an issue for Reliance. A company's financial statements must accurately reflect its true financial position. Director responsibilities, boards of financial institutions must demonstrate independent judgment. In capital management, maintaining capital strength is very important for the success of any insurer. And lessons for regulators. Regulators must show healthy suspicion and be prepared to intervene at the very first sign of trouble. And with WURA and other solvency legislation, we found the situation exposed the fact that WURA lacks language to bind the crown, and that is an issue. The second last slide is expanding Pacicc's resolution toolkit. The resolution of Reliance Canada and the Home Insurance Canada situation both demonstrate that the fact that successful actions can be taken by Pacicc without the need to assess the industry. It amplifies the need for closer examination of creative resolution options. These resolutions are early launch points for more study in this area. This is Pacicc's our 2020 priority issue. It's a good hook to talk about what we're doing this year. It shows the difference perhaps that maybe the focus could be on early intervention versus a traditional liquidation. And it prompts us to look at the sale, the transfer, and the reinsurance of books of business, and not necessarily just paying when things go bad. And ultimately, our goal will always be to enhance consumer protection, reduce costs to the industry, and strengthen policyholder confidence in the industry. And my final slide, I think, is that's a copy of I want to give a shout out to our operations manager, Danica Hall, that prepared the book, great layout, and did a phenomenal job on this. We'll be posting this on the website. We do have copies that we will make available upon request. We can send those to you. We'd be happy to do that. Every member company will be getting printed copies mailed to them. But in the meantime, you're going to want to read this, and we will post this right after the meeting and get that up for you to read. I think you're going to find it a very enjoyable read. So do hope you enjoy that. And thanks very much for your patience with this and your patience with our online meeting. So back over to you, Alistair.
Thank you, Ian. And thank you to all participants for your engagement in the 31st Annual General Meeting in Pacicc. To the members of our board who are planning to join us for our next meeting. It begins in 4 minutes. And so you will need to log out of this session and log into the next Zoom meeting invitation. Thank you all for your engagement today.